The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. My name is Brad Lewis, and I'm with Premier Life and Annuities. Welcome to the call today. The call is titled Overcoming Traditional LTC Objections. This is actually a unique opportunity that Premier is bringing to the table that has a true LTC benefit on this product. It's actually allowed and to be called and marketed it as a LTC product, so that's more than likely something a little different than you've seen in the past. And the other unique feature of this product that we're going to be covering today is it features both single and joint life options. And today on the call we have Jeremy with One Americas, and he's our regional marketing director that works directly with here with us at Premier. I'm going to turn the call over to Jeremy.
Hey, thanks, Brad. I appreciate it, and thank you all for taking time out of your morning. Like Brad mentioned, you know, it's very unique in the marketplace because a lot of riders out there and life insurance policies that have an option to add LTC, they're mostly what you would classify as like a long-term care rider, 101G. So most folks adding those maybe don't know that a lot of those policies have to be chronic in terms of, you know, it's got to be at least not only 2 of 6 ADLs or a cognitive impairment, but it's also must be what they deem as a permanent condition. So, you know, typical long-term care insurance, all you need is 2 of 6 ADLs or chronic illness. You don't actually have to be permanent. And so I think a lot of folks out there, unfortunately, are offering these long-term care riders, and if they're not careful, they won't know that they're actually offering their client something that must be permanent. So it is very unique. We also happen to have a patent on a joint life policy. And, you know, if you look at long-term care insurance as a historical, you know, sort of standpoint, they being companies, created long-term care about 35 years ago and said, hey, you know, we think we can offer this option to folks that if they need care, you know, they can file claim, and then we'll make some money, you know, for the folks that don't need to file claim. And unfortunately, their lapse ratios were completely off, as we're probably all aware. And they also, unfortunately, thought that most folks would probably evenly buy an equal distribution between the ages of like 55 and 85. Well, what happened? Mostly people in their 70s and 80s bought it, so their pricing was completely off. And it's kind of interesting. If you look at long-term care insurance companies in general, in 2002, there was 112 companies offering long-term care insurance, and right now you've got probably about 6 or 7 major players. So there's been a mass exodus towards, you know, getting out of the entrance, but there's been a mass, or getting out of the long-term care market. There's been a mass entrance towards the long-term care riders on life insurance policies. So what we've seen is this big sort of, hey, let's jump in the pool with just our feet and we'll just offer the death benefit. What we have here, and you'll see as we go through this sample policy, is we actually have not only the ability to accelerate the death benefit, but also the rider behind it is unlimited lifetime, which is very unique, and we're the only A-plus rated company to actually still offer that. So if we kind of go through this, I'm not going to mess around with the statistics too much. Let's see.
Hey, Jeremy, can I jump in real quick?
You there, Brad?
Yeah, I am. I forgot to mention that if anybody has any questions, to make sure that they type them into the chat section, and we'll answer all the questions at the end of the call.
Yep. So I'm going to just get right to this page right here, because this is really, when you're talking about our solution, you can think of it as 2 portions. So for you and your clients, it's 2 portions. It's the first part on the left that you see here is the actual death benefit. This is the life insurance policy. We call it a base policy, and you can accelerate 2, 3, or 4% of the death benefit per month per person. And I'll repeat that, per person per month. So in other words, if you know, it's not likely, but if both your clients went on claim at the same time, they would each get the same monthly benefit. They would not have to split it, which is pretty cool. So 4% of, let's say, a death benefit's $100,000 would be $4,000 apiece. They would each get $4,000 until they deplete the actual base policy. Again, that's for life insurance. And then right behind it, they would have the lifetime rider, or the rider of simply doubling their base. Obviously, in a joint, I think most people, you know, for roughly 20% more, most people would choose lifetime. It's not much more, and they then know that, hey, you know, if something happens to me, I get a Ronald Reagan incident, and I need 8 years of care, my wife still has a benefit she can never outlive. So pretty unique feature, and I think a lot of folks like the idea that if, you know, a client, God forbid, needs 8, 10 years of care, the catastrophic illness, they're not depleting assets under management. They're not, you know, stressing the family out on, you know, what are we going to deplete next? It's a completely unlimited benefit for both. So if we get out of here and we pull up an actual illustration, I think it'll look a little bit more sense here. Let's see. Okay, so we got a 60-year-old male and 60-year-old female, and it's about, so it's $4,000 a month is what they're going to pay. So think about a traditional policy, you know, $4,000, what do you get? It's use it or lose it. It's, you know, if I add inflation the first time they increase my premiums, that's what I lose. You know, if I die, I get nothing. So there's zero benefit other than care for a traditional, whereas here, each time that we pay that $4,000, that's going into the base policy. So that's going to the life insurance policy, building a death benefit, which they get instantly, and they have a death benefit of $134,318, which you can see here, and then for another $4,000 bucks. So instead of writing 2 individual policies on a 60-year-old couple for $4,000 apiece, we combine the joint, which we have a patent on again, and now we've got about $8,000 bucks, $8,100, and we've got a monthly benefit of $53.73, and that first benefit I went ahead and accelerated to 4%. So if you do 100,000 or 100% divided by 4, that would be depleted in 25 months, so about 2 years. So an example would be if the client went on claim, you know, 20 years from now, they're 80. All of a sudden, you know, they're going to get 53.73 for the first 25 months. And then what's really neat about this is if you go all the way down to the back, the rider behind in the 26 months has been compounding by 2% in this example. So in 20 years later, all of a sudden they're getting $7,827.45 for life for each person, and that would continue just like traditional to compound by 2%. So you have a catastrophic coverage. The first 25 months, they're going to have to pull from other assets to account for what would be most likely the inflationary factor, but after that, they've got a complete unlimited lifetime benefit. So very unique. The joint, the ability to have a joint is a patent. We have a lifetime rider. Nobody else has that. And the ongoing premiums can be broken down not only annually, but if you'd like, you can do monthly, quarterly, however you'd like to pay it. So really a unique feature as opposed to a, you know, typical, like Brad was mentioning, typical rider would be just accelerating the death benefit. So you would not have the actual lifetime benefit behind that. So if you go back to our screen here, most riders just accelerate the life insurance itself, not the rider, or not the, they don't provide a rider or inflation. And so to be actually qualified as a true hybrid, you not only need to offer the ability to extend benefits beyond the rider, but you also have to offer inflation. And those are the two sort of factors that you have to have. So very unique, very popular, because there's a lot of folks out there that maybe don't have a lump sum, and I think there's a misunderstanding in the marketplace that you got to have a big chunk of change for these hybrids, when really all you need is a monthly, quarterly, or annual benefit. So, you know, if you can just kind of make it a point to talk to everybody about this option for them, I think you'll find that when you can say to somebody, hey, what if there was a way that you could pay a premium, that the minute you write the first check, there's a death benefit. So if you don't ever use it, like we hope we never need it, there's a death benefit. It's tax-free to your heirs. If you ever need to walk away, you got a cash value, and best of all, your premiums are fixed and guaranteed to never increase. So very popular, very much cannibalizing the old LTC premiums. So with that, Brad, anything else you'd like to add, or are there any questions?
Actually, we're open for questions at the moment, so if anybody has any questions they'd like to ask, just go ahead and chat them into the question section of the webinar system. So I have a couple questions here. As far as adding, it's just been a great option. It seems the more that the producers are talking about this particular product and what it offers for long-term care, because it's definitely still a concern in the marketplace, the more activity we're getting on it. So it's just a matter of bringing it up as an option, because most clients don't know that they have a life insurance option that truly has long-term care benefits attached to it, as you said, Jeremy. So that's been very, very helpful in the sales process. So.
And I should mention, Brad, that so we talked about the two portions of our policy. There's the base and the rider. The rider is actually considered by the IRS true HIPAA qualified LTCI premium. So the base policy, obviously it builds a death benefit and cash value. It can't be deducted, but the rider is considered LTCI premium, and just like any other LTCI could be deducted on your client's tax forms each year.
And I do have a few questions here.
Okay.
Robin, yes, there is a brochure available, so we'll definitely get that to you after the call. That's not a problem. We can have one of your people that you work with here at Premier get that over to you. Ron's question is, what is the best way to get up to speed on product knowledge, and is the product available in California?
It is available in California. It's available in every state, but really New York is the only one that we just don't do business in. But best way really is just contact Brad and his team at Premier, and if they need anything that I can provide to, we can do that. But best way really is just pick a client, pick yourself, pick your family, something like that, and run an illustration. That's how you're going to learn it. Obviously, like anything else, if we ran the same illustration for an 80-year-old versus 60, it would be more expensive. So, our wheelhouse on these ongoing premiums really is probably 45 to 70 for the most part. We will write to 80, but it just gets obviously more expensive.
Okay, I got another question from Wilbert Payne. In California, the Department of Insurance will not let me inflate the base policy. He's asking why.
You know what? And actually, I don't know the reason why. It's obviously a Department of Insurance deal, but that's not uncommon. Sometimes there's a few other states that are that way. So, but typically we don't add inflation on the base. Usually we'll let that first 25 months just be standard flat, and then add inflation on the rider. And the reason for that is just because it's awfully expensive. So instead of $4,000 in premium that we showed there, it might cost $8,000 to have, 5% inflation or something. So.
Let's see here. Steve. He was just asking to go back to the example policy illustration that we had up, just to show him that again.
Yep.
Maybe just cover that real quick, how that lays out.
Yeah, no problem. So when you think first, before we go there, just remember there's a base policy and a rider. And then when you look at the policy itself, I'm going to shrink it down a little bit so everybody can see it. Oop. So there's a base policy and a rider. So there's two options here. The rider is completely optional, but you do have to choose it before the policy is issued. So you have to add this premium of $4,000 plus this premium for the rider. So your total premium would be $81,44.62. And that would give you $5,373 for life, and then after you got through the first 25 months, which you can see here, then you would get into the actual rider, which in any given year would be whatever it's compounded to. So I'll go back to that snapshot here.
And if you're looking for something else, just let us know when we call you after the webinar here, and we'd be happy to give you any specific examples that you're looking for.
And I can send this to you, Brad, and you can distribute, the PowerPoint and this.
That'd be great. Matt, his question is, when someone gets the COB rider for care and on claim, does the benefit continue to grow at the compounded rate, or once the claim starts, does the growth stop?
A great question, Matt, and that is absolutely the case. So it would continue to grow even on claim. So, worst case, if we go to this rider here and let's say they're 80 and the gentleman goes on claim at 20 years from now, he'd get $7,827, and each year, even when he's on claim, it would continue to compound up by 2% in this option. By the way, we do offer 2 through 5, so you could do 2, 3, 4, or 5% inflation. And then let's say he passes away a year later. Oh, by the way, when you're on claim, the premium stops for the rider. So when you first file claim, we always add, and Brad would always add this, but waiver of premium on the base. So when you file claim on the base, you still have to pay the rider for that first 25 months. So 2 years, basically 3 years, you'd be paying that rider. And then all of a sudden, once you deplete the death benefit and the base policy, you file claim onto the rider, then automatic waiver of premium. So in my example, all of a sudden, he goes on claim, for the first 25 months, he's depleting the base policy, then he files claim onto the rider, premium stop for the rider, then let's say he passes away, then she has to pick up that premium for the rider of $4,100, $44.62, and then the minute she files claim, all of a sudden it's compounded to whatever it is each year that it's grown to. So let's say 25 years later, 5 years later, she goes on claim. Now she's getting $86.42.13 for each month until, and that continues to grow as well. So great question.
And that's the key to this product is the joint life. It really makes it work very, very well. So Steve has a question on underwriting, how in-depth the underwriting process is as far as what we look at.
Yeah, so we do have simplified underwriting, which is just a phone call. But on these ongoing premiums like this, typically the way that I would tell any advisor or agent is just set the expectation that they're going to want exams, records, because it obviously is the most risk to the company when we're just taking a monthly or annual premium. So I would paint the picture that we want exams, records, and it's going to be pretty in depth. Typically, we will bypass a phone interview in lieu of those, but every once in a while, if you got somebody that's healthy and they see a doctor every year, we would actually potentially just do a phone call. But I would, again, just set the expectation that it'd be exams and records.
Ron's asking if we need LTC partnership courses to be able to sell this. He's asking specifically in Florida, but if you want to touch on all states on that one.
You know what, if the state itself requires an LTC certification, whether that's, some of them are only like a 4-hour online, it'll take you 30 minutes to complete. Others like Colorado are 16. So, it just depends on the state you're in. Most are, I think, 8. But yeah, you do, because it's considered true LTCI coverage, you are required to have that. And I really think, we were talking a little bit before, Brad, but I really think these chronic illness riders that folks are selling without a license, it's only a matter of time before they require that too, just because, there's a lot of folks out there think they have LTCI. The guy has a stroke, and then all of a sudden goes to file claim, and the doc says, no, we think he'll be good in, 9 months, and they don't pay the claim out. So, long story short, you do need the LTC cert. Absolutely.
Okay, I got a few more questions here. If the policy owner dies before the second insured does, the second insured assumes ownership even if the first owner wanted someone else to be the owner, is the question there.
Okay, so basically the way we underwrite it, it's the owners, could be kids, they could be friends, it doesn't matter, business partners. The joint life, all we ask for is an insurable interest. However, the insureds, you know, like I'm taking from that question, if it was a husband and wife and let's say he passes away, you know, never needed care or did need a little bit or whatever, it would automatically still remain in force for the other second insured. If the second insured wanted to change ownership, they'd have to completely go through new underwriting and write a new policy at those current rates. So you can't really transition to somebody that's not already on the policy.
Okay. James's question is that you mentioned it's fixed premiums for standard life insurance, and his question is, does that also mean the LTC rider also has fixed premiums and won't increase in the future?
Great question, James, and that is really, you know, out of all the things, you know, okay, if I don't use it, I got a death benefit. If I need to walk away, I got cash value. But the reason we've seen a real substantial increase in these types of policies is for that exact reason. Both the rider and the base are completely what we call non-cancelable, totally fixed, can never be increased on the client. So the nice thing is you write the policy, you never got to worry about, you know, the client getting a letter saying, oh, your premiums are going up 60%, you know. So it's the reason why we've seen a lot of this.
Never have to have that conversation.
Never have to have it.
What is the value of the non-forfeiture benefit?
So I have never seen, and I've been with One America going on 9 years now, I have never seen an agent or advisor add it. We would all make more money if you did, but it just doesn't make sense. The non-forfeiture only, so what it basically does is it says, hey, you know, you're paying this rider premium. If you walk away, that premium, because it went to life insurance or long-term care LTC coverage, is gone. So if I decide I'm going to pay these premiums and I'm putting $4,000 a month in the base and $4,000 in the rider, those premiums towards the rider are going to be gone. If I turn around and walk away, I'm just going to get the cash value from the life insurance policy itself. So if you add non-forfeiture, it says we'll give you your premiums back, but we'll only give them back to you in the form of a care benefit. So all of your premiums are going to be spread out over your base duration. It doesn't make sense. You know, if you're walking away, you're thinking, I don't need this policy anymore, which, by the way, our retention is like about 98.8%. So most folks aren't going to add it and pay more because if they walk away, they don't care about the care benefits. So what good is getting my rider premiums back spread over 25 months?
In the example that you used on the illustration here, the question was, does the premium include the 2% rider?
That premium does,
rider?
Yep. And actually, I think we can go, let's see, I think we should be able to show it right here. So if we went with 0% inflation for lifetime, that premium would be almost half, $2,118.90. So if we just wanted to keep the payout level at $57.33 or whatever it is, then it would be about half. But you know, most folks decide, well, you know, for another $2,000 a year, so $4,000 each. You know, they're calling Premier saying, hey, can I get a LTCI quote for $4,000 each per year? And then they're going, well, these premiums could increase, you know, and then, you know, first thing that we lose is inflation. And so here best thing is just get your clients check writing tolerance. So if it's $4,000 each, we run an illustration with Premier for $8,000.
Okay. Todd, hopefully that answers your question, that there's many options available on the inflation rider, all the way from 0 up to the 5% there. So next question, who can be the second insured on the policy?
That's a great question. Actually, I didn't cover that. So all we care about is it's an insurable interest. So it could be business partners, it could be brother sister, it could be same-sex couples, it could be boyfriend and girlfriend that live together for 2 years. So all we ask for is some sort of insurable interest. Typically, and most of our policies are husband-wife, but anything that we can consider an insurable interest, we'll write it.
Okay. Can you borrow against the cash value of the policy?
You can, and then it just reduces your payout pro rata. So everything comes out proportionately. So if I take 10% and I don't pay it back and I go on claim, my benefits are 10% less.
Waiver of premium only applies to the writer. That's a question.
So the way that Brad and really my internal Daniel, all of us would run an ongoing premium is we'd always add waiver of premium. So what you're seeing here is reflective of waiver of premium on the base as well. The one thing you got to know is when you file claim, remember there's two portions of the policy. Your first claim goes on the base, so you're still paying your rider premium until you actually deplete the base and file claim on the rider. But the base, the way we run it and Premier runs it, is definitely waiver of premium. Now, we do offer anywhere between 10 through 20-year pay, limited pay, which is kind of unique in the marketplace because most long-term care insurance these days, if not all, is ongoing premiums. They want the ability to just raise premiums on folks throughout their whole life. Whereas we can say, you know what, what's important to these folks? They want to be paid up. They're 60. They want to be paid up by 70. We'll do a 10 pay. They want to be paid up by 80. We'll do a 20 pay. Anywhere in between. So you could do a 14 pay. But we always typically add waiver of premium when we quote these.
Okay. Inflation only applies to the rider?
Well, there is base inflation, but it is definitely expensive. So most folks in this example would run with the 25-month at no inflation. They're kind of making the agreement with their advisor. Hey, you know what? First 25 months, we're only getting $5,700. We're going to have to pull from the CD or the IRA or take our RMD or whatever, and make up for the difference. And then all of a sudden the rider kicks in. So you can put inflation on the base. It's just going to be awfully expensive.
Okay. Next question is: Can a trust own the policy?
Sure can. Yep. Typically, it's an irrevocable trust, but we can definitely do ILITs. It's just a little complicated with they got to make sure that the payees and the way it pays out is all correct, and that's on obviously the legal end. But trust, we see that a lot, and the trust can be the beneficiary and the owner.
Okay. Next question is: we have a few more here. If you have a whoops, I just lost it there. Let me go back up. If you have a waiver and one insured dies, are the premiums still payable for life?
They are. Yep. So it's not cut in half or discounted. It's that price based on both people's expected life expectancy. So if I pass away and my wife's still alive, she still pays the exact same premium. What
is the maximum monthly benefit that's available on the contract?
So the maximum is 4%, which is what we're showing. And on this ongoing premium, we almost always run that. So 4% of whatever the death benefit is. In this case, the death benefit is $134,318, and we're taking 4% of that, the max, per month per person. And remember that. So if they both file a claim, I think a lot of people think they make the assumption we got to split the payout. They each get it. So in theory, although it's unlikely, you could both go on the claim and you'd actually deplete 25 months and 12 and a half months and be into the rider.
So they could actually take out a policy for $250,000 as a base policy, and then their benefit would be, is there a maximum face amount for the policy?
Yeah, there is, and unfortunately, for all of us, I've never actually seen it hit, but it's $1.5 million is your maximum death benefit, which a 60-year-old couple, you could see how much that would take.
We take that
quite
case,
a bit.
though, right?
Yep. Yeah, somebody's got that case, right?
Yep. Here's another question. What happens to the death benefit when the cash value is depleted on the first person to use the 25-month benefit?
So the death benefit is a reduction dollar for dollar. So the cash value is going down dollar for dollar and the death benefit. So at some point, your cash value would actually be depleted. You'd be into the leverage from the life insurance. And then after that, then it would all be gone. There's no residual life insurance. It's just you're into the rider.
Okay. What is the longest claim period? And that's obviously it's lifetime, I would assume.
Yep. And so, best thing to do, like with your client, is sit down and say, God forbid, when you got dementia, here's 57 or 53, 73. And if we take that, we say 53, 73 times 12 times, let's say 8 years, that would have paid out over $500,000. It was 515,808, or sorry, 515,808.
Okay, I got a couple more popping in here. So he's asking, actually, just to clarify that question, he was asking what the longest claim period experienced by the insurers. So,
the company won't share that even with me. So I'm sure there's been a dementia about I think it's maybe 12 years, something like that. But I'm with the rider. That's where we make our money. So a lot of folks might just never even need care, let's say, and we just collected all those premiums. So obviously you can tell by this illustration that the death benefit is not anywhere near what you'd get with a normal life policy, but that's because obviously our risk is twofold.
Okay, and then the next question is, can funds be used to pay anyone, for example, family, et cetera, to assist, or only care center, or only a care
question.
Center?
So we do require that whatever state that the client is in, it be considered an actual licensed care facility or care provider. Excuse me. So, some states are pretty lenient. Others require an actual license. But typically, you're not going to be able to, pay your daughter or son or whatever. The only way to do that is we do have a benefit on here. You'll see it's called caregiver training benefit, which I'll highlight down here if it'll let me. And we'll allow, in this example, $10,745 to train, your loved one. And it might be that you train them and they go through the licensing and then they get hired by a provider, and we still have to pay the provider, then who then pays the relative.
Okay. What is the average LOS for Alzheimer's?
8 years is what they're saying right now. But I think that's not, 8 years in the actual facility. That's from the minute you're diagnosed to the, end point.
The next question is, if there's a large difference in age between the joint insureds, I think is what was meant here, would it be more advantage to have individual policies?
Actually, it depends on how you look at it. So if, let's say, the husband's 82 and our max age is 80 and the wife is 65, then we would do what we call a joint equal age. So it's not exactly half. It's actually more favorable on the downside for her because females are weighted more favorably. So, their joint equal age might be 76 or something. And even though he's 82 and he's over 80, we could actually write that policy, assuming they're both insurable. So max difference is 25 years.
Okay. If the first person depletes the insurance policy, does the second person only pay for the long-term care rider?
Correct. The minute the base has been depleted, there's no more premium due because you've depleted the life insurance and you're into the rider.
So then, okay. What is the maximum monthly benefit for the base period and for the rider period?
So the rider is one of two things. Either I double my base. So my base, if I take the max of 4% out per month of the death benefit, 100 divided by 4 would be 25 months. If I deplete my 25 months, my rider is either an additional 25 months or lifetime. The difference in cost is roughly like 20%. So most people, especially on a joint, they opt for the lifetime. But you could see how maybe if you've got a 76-year-old widow, you know, she's got to make sure that it's still affordable. She might do 25 months and 25 months as opposed to lifetime.
Yeah, and he's asking what the maximum amount per month. And you mentioned that the base policy, the largest base policy is $1.5 million.
Right. So if you take 4% of that'd actually be the maximum.
Yeah, 4% of the 1.5 million is the maximum. So okay.
Right. Then the rider's capped at 12.
Okay.
And again, if you're lucky enough to have that case, we're happy.
And international coverage, is that worldwide or for any SNFs?
It is worldwide. It just needs to be, it's facility only, and it's capped at half of what the normal payout would be. So in other words, your death benefit would last 50 months, not 25.
And then a follow-up on the age difference for the clients from Steve here. He says if the male is 70 and the female is 50, would it be more advantageous in that case? And I think in that scenario, we would. That's kind of what we do here at Premier, and with the help of Daniel, is run the different scenarios to make sure the client has the better offer.
Yeah, it's totally situational. I mean, you could look at it two ways. You could say, well, she's getting kind of a reduced benefit with him being so old, but you could also say he's more than likely to have a claim first, obviously, and by her being younger, gives him a better benefit than he would have ever got on his own. And also from an underwriting perspective, we're not gonna write it on somebody that's uninsurable, but if he's got some health issues and she's healthy, we're a little bit more inclined to do a joint than we would be, just an individual policy on him.
Okay. And then one follow-up question that kind of goes along with that is a single premium policy costs more than a joint policy. They're just asking why that is the case.
Yeah. Well, it's just the simple fact that if you have a single policy and I pass away, I got to pay out as the company. I got to pay out the death benefit right away. Whereas the second to die, he passes away, she's still healthy for another 10 years. We don't pay the death benefit out until she passes away. So it's a patent, and if every other company out there that the minute that our patent expired, they would jump on that. But it's when you think about it, are they going into it for death benefit or cash value? No, because if they are, you got other policies with Premier that can do much better. But if they're going into it from a joint perspective, a second to die, basically what that translates to is better benefits than two individual policies, and it's for that exact reason. It's a second to die.
Okay, well, Jeremy, that looks like all the calls that we have for today. Do you have anything in closing, and then I'll finish up?
No, sir. I just think the one thing I would say is, the advisors and agents that are doing this successfully, they're bringing up every single client they have. It might not be the first meeting. It might be the tail end after you address the income issue or something. But every single time they're saying, hey, what if there was this way that we could have a fixed premium that you build your own sort of account, your cash value. And if you don't ever need it, like we hope we don't, then your heirs or your trust get something. So that's the best thing I could say to everybody is just incorporate it into your practice.
Okay, perfect. Well, I'd like to just take a moment to thank everybody for being on the call today. Definitely appreciate everybody taking time out of their busy schedule to spend a little bit of time with us. Actually, someone from Premier will be contacting you after the call, but if you need to hear from us first or speak to us first, our number is 800-365-8208. And if you just ask for a life or annuity marketer, we'd be happy to help you. And we look forward to reaching out to you and finding out what clients and prospects you think might be a fit for this product. Thanks for your time today, Jeremy, and thanks for everybody for attending the call.
Thank you.